Good morning, ladies and gentlemen. Well, not much to see from the model. The scores keep on being positive, and therefore it keeps on telling you to prefer equities to bonds. But as this is a mathematical model based on moving averages, these moving averages can give you false signals, and they will give you false signals at times. It is quite possible that it will keep on giving false signals if we stay in this range and we don't have a sustained move away from the long-term moving average here, and I think that's quite possible. Therefore, ignoring the mathematical signals at the moment is important, and just looking at the score is what is important. While it is positive, it's still risk on. It's still the likelihood that equities will outperform bonds is more than 50%. It was a quiet week in bonds, and really, as you can see, it was all dominated by the German-French spread, and really every other bond market, including the US, traded off it. We stayed in a narrow range last week, and really these lines are important. This 78 to 80 level and this 62 level. And if I go back in time, you can see why they are so important. And it goes all the way back to 2011. And we've remained in that range basically since 2011, 2012. Now, I think that the ECB will be ready to intervene after the first round of election results are announced in a few hours' time in France. I believe that the ECB will help all the way until the new French government does something to break the EU budgetary rules. Unless that government does something like that, the ECB will continue to want to help. Don't forget that Lagarde is French, and don't forget that the politicians are on the phone to each other and the ECB all the time. The last thing that the French government wants is a panic on Monday, and let's actually work through what is likely to happen on Monday. Now, we don't know what the results are, but even if they are as bad as the market suspects they will be, the market has already adjusted. Therefore, I think the risk reward is that this spread actually is supported at the previous lows and starts coming in, because the second round can only be better than the first round, because after the first round, I think they will have discounted the kitchen sink. They will have discounted a complete victory by the far right, I guess. And therefore, after that, how much more can this spread go until the new government does something, which the market doesn't like? But that is going to take some time. It's going to take many, many weeks. So I would have thought that the trend, if we gap down, and the risk reward is going to be to actually buy the spread and look for it over a period of a couple of weeks to come in towards 62 with support from the central bank and with the market already at an extreme. Where is your stop? Well, that's the question. Really, any kind of a weekly close below this 80 level, and you know that chances are that you are wrong. Those are the risk reward points. I don't think that it's a trade worth doing in very big size, but it's something that I'm looking to do Monday morning. If we open down here, I think that the risk reward is to buy it for a return to around the 66 to 62 area. I don't think we're going to go through it because the market will always be discounting that the new government will do something, and therefore they need some margin of safety. But I really don't see that we will be busting through this minus 80 area and discounting immediately that they are going to do something. Because let's face it, the best chance for Marine Le Pen to actually win the presidential election in a couple of years' time is to show that her government can be responsible and can maintain France's position within the EU budgetary constraints. Because if she doesn't show that, chances are that very bad things happen to this spread, and then that very bad things happen to her electorally. So I really don't think that that is what her first move is going to be if she becomes prime minister. I think it's far more likely that she tries to calm the markets down rather than the other way around. Maybe even a better way of knowing if I'm wrong on that view is if the 10-year oat breaks 324 on any kind of closing level. You can see from this date, which was the panic date, that even then we didn't close below 325. So if the market gaps up, I expect that there will be quite a bit of pressure for it to come back. But if we start closing above 325, I guess I'm wrong. That's all I can say, because then the pressure persists and then we're looking to go towards this 360 area. I don't think it's going to happen immediately for the reasons that I just gave you, because I don't think it's in the interest of the politicians to do that. But that will be a big deal. As you can see from this chart, it's going to be a very big deal indeed. And I guess that will drag up certainly the spread and certainly make the yield curve in the EU steeper. As you can see, this is two tens, Germany against France, and that really didn't move. So the flight to safety is still there. I expect it to come back towards this kind of 20 area. But if it doesn't, you can see what this looks like. It can get very, very bad indeed very quickly. The 200-day moving average has turned over, and as they say, nothing really good happens below the 200-day moving average. But that is your risk-reward at the moment. I think the risk-reward at the moment is we come back towards 20, i.e. the panic subsides, and only later can we go and test these levels again. If we look at Germany by itself, the interesting first takeaway is that we keep on getting a 200-day moving average which is rolling over. And every time we go and test significant levels, like here at 311, the market comes back off 40, 50 basis points. Now, I don't think that we are beginning a downward trend, but what I do think is that the upside in all these contracts is very well capped. You can see for yourself that whether we look at twos or we look at fives or we look at tens, the picture is much the same. I find it difficult to believe that if the market backs up to this 252 level and you buy 1 month, 2 month, 3 month calls, that you're not going to see it eventually around this 220 area. Very difficult for me to believe that we are going to have a trend which takes us much higher in price, whatever contract you look at and whatever tenure you look at, even the 30-year. I think the ranges to the upside are very well defined and delineated, and anywhere close to them buying calls or call spreads is likely to be profitable. At some stage during 2024, I expect the levels that we started 2024 at to be tested. Now, does that mean that we necessarily break a long way below them? I don't know. Probably not for the time being. There's nothing that says that we should. But I think at some stage we do test them. Therefore, in Germany, stability with an upward price bias over the course of the summer is what I can see. The US basically spent all week going sideways, whatever tenure you look at, but it just feels like it wants to do better eventually. Now, we do have auctions next week. We got 2s, 5s, and 7s, and they're big amounts, approximately 180 odd billion. So, what is the logical move for the first couple of days, given that the auctions are Tuesday, Wednesday, and Thursday, and that the data is very light until Thursday when we have, I believe, durable goods and, of course, unemployment claims, and then on Friday we have PCE. The logical thing is for everything to start backing up a little bit, whether we talk about 2s, 3s, 5s, or 10s. And 10s is what people are going to be hedging the 7-year auction. I mean, I don't mean 10s cash. They'll be hedging it with the TY future. So everything backing up a little bit towards these kind of levels, 433 in the 10s. And then it should start anticipating the really good PCE. Now, I don't think the good PCE is a buy, because we all know that the PCE is going to be good. The good PCE is when you want to sell the spike of people buying the good PCE. I really don't think that that is important at all, and I think that that is in the market already. So you want to be probably buying Tuesday, Wednesday on the dips of the auctions and selling Thursday evening, Friday morning on the good PCE. Hopefully the PCE can even be like a third digit better than expected, but who cares? It really is not going to go a million miles. If we see these kind of levels in the 10s, 416 down to 415, those are really levels you don't want to be involved at the long end anymore. And if you look at, the shape of the 200-day moving average, it is rolling over in the 2s, it's rolling over in the 3s, it's rolling over in the 5s. It's pretty stable in the 10s, and it's still rising in the 30s. That tells me that the likelihood is that the yield curve, if it does anything, it should steepen, because the pressure should start coming for lower rates. Look at the 1 year. It's basically telling you that there is zero, or as close to zero, likelihood of higher rates. And at some stage, some number comes out which panics people, or panics people into thinking that the Fed will panic, and the short end comes down. The reinvestment risk in the short end is just too great. Why not buy 1 year at 510 if you know that rates are going to be capped at 535? When the Fed is also telling you that they're going to do 1 cut in 2024 and then 4 cuts in 2025. The risk reward of not buying it is just silly, I mean, unless you think that rates can go up, and I don't think the market does, you want to be owning 1s, 2s, 3s, and really, because of the negative, and don't forget we're now at negative term premium, why would you buy the 10s and why would you buy the 30s? It just, just doesn't make that much sense to me. The only thing that makes sense is because real rates are around 2%, and the Fed probably does not want real rates to go much higher, simply because it would then threaten the economy if maintained for too long. So I think it's going to be narrow trading ranges, but every time it gets to a technical level, like 448, something like that in 30s, you want to buy it. You want to buy call spread. I think the logic of it is quite clear. If we look at the differentials between the US and Germany, I think the ranges are quite well defined, and that is why I think that the likelihood of a complete panic on Monday is actually unlikely. And this is the triangulation that I look for to see if buying any kind of gap down in France is actually warranted. I think it's very, very unlikely that we break this 190, 191 area. We are really now in this range 172 to 190, and I think we can persist in it for a while and maybe even start turning the 200-day moving average. And then we will know, because once we bust this range to the downside, we will know that that is when the Fed is also likely to start cutting. And we can probably tell that easier in the twos. As you can see, the twos have gone up because the flight to safety in the in Germany from the peripherals, and that has made Germany go up again against the US as well. But I think that we are unlikely to even bust that. And if we look at the 5s, we can see really that the range is down here from 170 up to probably somewhere around here, 202. So those being the ranges, I think it's quite likely that eventually we start turning them and that we start heading back down towards these levels where we were in most of 2023. But that will only start happening when it's very close to Fed cutting time. The dollar did exactly what I thought. It found support around the 105 area and is now trying to head towards this 106.25, 106.30 area, which I think is going to find very, very difficult to break. And if there is a gap down in Euro USD and of course a gap up in DXY, I think that that is that kind of a level that you really don't want to be involved in anymore. If we look at the Euro USD, any kind of level around this 106 area, I think you want to be out for the very same reasons as I gave you for the bonds. I think that the market needs to wait for something to happen in France, i.e. for the new government to be formed, and then for the new government to actually do something which breaks the EU budgetary rules and puts the whole of the EU and Euro construct in danger. I really don't think that that is likely to happen for many weeks or months, and therefore I think any kind of a panic on Monday morning at these levels you want to get out, because I think it's far more likely to come back. Just as a panic subsides in bonds, it will subside in FX. And I really don't think that this is something that you need to worry about immediately. Maybe in the longer term, Le Pen as Prime Minister might do something silly, but I don't think she does something silly immediately for the reasons that I gave you. I think gold showed its true colors on Friday. This 23.72 275 level could not be maintained and it got slammed. I think it's far more likely, and this actually triangulates with my view in bonds and my view in DXY, that now it starts to test this 2310 level and break it. And then we're heading here. And I think that is going to be a major buy level, probably around 2230, 2225. But I think that we need to clear out all these longs up here and really, just slam them at some stage, probably towards the end of next week or the beginning of the one after, and come down here, and that is your buy area. DBC doing absolutely nothing. This is the second kind of inside week that we've had. So I really can't see it coming out of this range, which tells me that oil at these levels around 81 to 82 is probably toppy as well. And that, coincides and triangulates with my view in bonds, i.e. a little bit higher for the auction, then a little bit lower ahead of PCE, then back towards the middle of the range on PCE, because everyone knows what PCE is. And that very much triangulates with commodities doing not a lot, and gold actually getting a bath out of it because it's probably too high against commodities and it needs to come down a little bit and consolidate. So nothing extreme in my view. I just don't think that it's the time to play these instruments. Let's take a deep dive into equities because I think it's important at this stage. This is my clean chart, and let's have a look at enlarging it. And while this pattern persists and we are above this 5372 area, 5375, whatever in SPX, there is absolutely no weakness. I mean, none at all. And after that, this 5327 to 5372 area is very, very likely to catch it for quite some time. Unless bonds start moving away from where they are, or we get some risk off. And to get risk off, we need data which shows that the economy is rapidly cooling. And I don't think that we're going to get that anytime soon. The likelihood of equities breaking these levels, I mean, either one of these two, to me seems not great, okay, in SPX. Why bother playing the downside at the moment? I really can see not a lot of reason. I'll be a much better buyer once the market adjusts from these extremes. And let's have a look at what the extremes are. They are all in the longer term charts rather than in the shorter term charts. It's the weekly chart and the monthly chart which are overextended. Okay, you can see the weekly chart. That's why I think it's far more likely to come back within the course of the next 1 or 2 weeks and test these kind of levels around, whatever that is, 5390 or something like that, and then go again. I think it needs a bit of a pause on the weeklies and especially on the monthlies. So this is now a monthly chart, and we will of course close the monthly bar this week. And so let's have a look at an enlarged monthly chart. It very, very rarely breaks. I mean, in my experience, never does it break the Bollinger Band to the upside without retesting it the month after. And we are at the top, and you would have thought that this kind of level is going to be support next month, and that's 5350-ish. Or 5370, 5350, whatever. That is the kind of level that it needs to break to show any kind of weakness. I don't particularly expect it. I expect it to still remain firm, but you will see that only once we start breaking on the monthlies below these moving averages is there any weakness in store. You can see how all year we've been going up at the speed of this red moving average and bouncing off it and going to the top of the Bollingers. I will have those levels for you as soon as it closes the monthly bar, and those are your buy and sell levels above the Bollinger Band and at the red moving average. The monthlies on NQ, and you know, I still like it. I still think it's likely eventually, even if we have a little bit of consolidation next month, I think it's still likely to go higher. I just don't see the pressure at the moment on NQ because bonds aren't pressuring them, and I can't see that they will. I think that if we see any kind of retracement next month towards this green level, which is going to be around 18,300, 18,400, you buy call spreads again because it's going to go well over 20,000 by the end of the year. So long term, I'm very positive. Short term, I'm slightly less positive, but that doesn't mean that I'm negative at all. I don't sell NQ. I just look for levels to buy that make sense. And I think that if we get anywhere close to this moving average, and next month it's likely to be what, around here, that is your buy level. Within 1%, you buy call spreads and you look for it to go higher. But what I do think is that NQ is going to be far more volatile than SPX on the way down, simply because the components could be a lot more volatile, having, you know, Nvidia having gone up like whatever percentage, it can easily give up a third of it. So if it's gone up 140%, it can give up 30% in no time at all. And that would cause this dip, but that dip is a buy. What is going to be very interesting on Monday is the stocks. And 48.49 has been this level that we just can't close below. This is a monthly chart, and 1, 2, 3, 4 months we've tried this 48.50 support, which is a support level that has lasted, well, since the late 1990s. So we are breaking out of a 25 plus year range, and we cannot close below it. That to me says that we're going higher eventually, and that is why I think that any panic that can, you know, possibly exist on Monday is going to be a short-term one. Because let's think about it. If we're going to get spreads moving out hugely in Europe, which basically means that the whole of the periphery is in trouble, and the very construct of the euro becomes into doubt, because let's face it, France is not Greece. If France goes, the euro no longer exists. So if all these things are boiling in the background and still stocks can't close below 48.49, that tells me that it's all temporary and that it's all going to get reversed, and that really stocks is a bit of a buy. You just buy some call options. And I think that after, 1, 2, 3, 4, 5 months going sideways, we are probably ready, you know, if the news isn't bad, to start going up again and testing the top of the Bollinger Bands. Just imagine the smell, you know, as they say, if rather than puking, this market now starts making new highs. So naturally, everything I've said is dependent on the results of the election, but I really don't think that, unless it's very, very unexpected, that the market is likely to take that French spread further than we've seen. So these are the levels that you're looking at. And anywhere around this minus 80, I think it's far more likely to bounce towards minus 62. And I'll also be looking at the stocks, which is in sort of like semi-panic mode. But if we can't even go down to 48.50, I think the likelihood is that we test the upside over the course of the next few weeks. The first move is going to be tentative, limited to this 5,000 to 5,050 level. But if we maintain those levels, I have absolutely no doubt that by somewhere around the middle of July, we're actually making new highs and everybody's going gang-ho on Europe again. So that is what I'm looking for. NDX also, if it starts coming back, I really want to start buying calls. This is the first level that I don't think is likely to be broken next week, as well as 54.10. But if we get 2 or 3 weeks of weakness in these indices, again, I see absolutely no reason why they wouldn't continue sometime around, the middle of July. But when you think about it, and this is the parting thought, where is the risk of election damage now? But surely it's going to be, once the French results are known, it's going to be far more in the States than it is in Europe, right? And that is another reason why I think, the stocks could be very, very interesting to pick up. Thank you very much indeed, and tweet you on Monday.